Thanks, Andrew. All right, so this panel, the title of this panel, should banks just focus on credit risk and let the industry handle the energy transition? So, no, right? We're all good? Yeah?
Done? We're done.
We're done, right? It's a short panel. No, for those that I haven't had the privilege of meeting yet, my name is G. Kim, a shareholder at Vedder Price. It's my privilege to moderate this panel this afternoon, and thank you for joining us today. Just short sort of some introductory thoughts here before I introduce the panel. As Andrew mentioned, it's a common theme at this conference and at other past Marine Money conferences, and I'm sure it will be for the foreseeable future that, I mean, the reality is the global scene, it's something that we can't ignore of shipping's ambition to decarbonize, right? I mean, that's the parameters in the lay of the land today, and the technology that's available to assist existing ships. I think the question was asked to reduce carbon footprint and improve the efficiencies that we see in the market. You know, it was mentioned about collaboration, you know, the various stakeholders in our industry, whether you're a ship owner or an investor or a financier, and whether that's due to internal or external pressures, there is a drive, right, to assess and address the decarbonization matters and issues, the ESG requirements, whether that comes from the investor side, whether that comes from the bank side, or just driven by the company's responsibilities and social responsibilities. So there's a lot of various factors that go into this question. So we'll try to focus that on in our industry a bit, but I think for purposes of this discussion, I think it'll lend itself to perhaps a bit more of a bigger scale, of a macro view, and we'll try to see what each of these the panel members have to address. So, so the question is a bit leading as far as the title of this panel, but because clearly I think it's been pretty clear that the banks aren't going to be sitting on the sidelines. They're going to be doing the responsible thing and taking a leading role in how these issues, these global issues, are addressed today and in the foreseeable future. So on that note, I'll introduce the panel. And starting from my far left here, Philipp Rohr, Global Head of Shipping at Hamburg Commercial Bank. Thank you. Next to him is Stephanie Leow, Managing Director and Regional Head, Shipping Finance at Standard Chartered. And to my immediate left here is Quincy Chan, Director of Asset Finance and Leasing at National Australia Bank. So let me just start off by it's such a wide topic, so to help us focus, if I could ask each of the panelists to basically do a short introduction of your own institution, but framed in the context of your current engagement and role in the shipping sector's energy transition endeavors and the decarbonization efforts. So perhaps maybe I'll just start with Philipp on the way down there, and we'll go down the row here.
Can everybody hear me? Yes, perfect. So I'm representing here Hamburg Commercial Bank, formerly better known as HSH Nordbank, one of the biggest shipping lenders in the world. Today's market, we have roughly a shipping book of 4 billion, and we have focused within the last, I would say, 3 to 4 years more on second-hand vessels, because we take the view that we have to talk about reduction of CO2 emission, but currently we are missing the alternative fuels, and they will be not there within the next 2 or 3 years. So it's a long-term approach, and therefore, as already mentioned before, we should consider how we can improve the efficiency of the vessels which are today in the water. Because if everybody would just go for new builds, we might have, again, overcapacity in the market, which we have seen in the past when the market was in a bad shape. And therefore, we as a bank consider that we have to support our clients, whatever measurements can be done, improvement of the vessels, but we will not force the clients to go for new builds just to have a more efficient vessel. Because as everybody knows, there might be a handy-sized bulker which is currently using 14 tons of fuel, and a new one will take 12 tons or 11 tons. This will not make the needle. And therefore, I think it's worth to consider within the next years how we can improve. We have to improve for sure, and there's already an existing regulation in place. So all our clients have to comply with IMO regulation, and therefore I think the bank don't have to push or press more the button for the clients.
Excellent. Stephanie, moving on to you. I think with Philip, it's coming from a European bank perspective, based in Europe, and switching. And I think the panel here, it's quite nice. You get a global feel, in a sense, with this topic. Stephanie, if you could introduce Standard Chartered and sort of your efforts at the institutional level on this topic. Yeah.
Sure, thank you. So I think in terms of sustainability, we've come out and said that our vision is to be the world's most responsible and sustainable bank. So that's a big statement to make, right? And to that end, Standard Chartered is big in emerging markets. And because of that, we do know that emerging markets are the places that will need transition finance, that will need investment in transition finance in order to achieve their net zero goals. We have joined the Net Zero Banking Alliance, and as a member of NZBA, there are targets, there are actions that need to be taken in order to set targets to be achieved by 2030 and 2050. And one of the key action taken is also to take steps to determine what are our priority sectors that have the biggest impact in transition towards achieving, ensuring our portfolio achieves net zero by 2050. And shipping has been identified as a transition industry. If we go into numbers, Standard Chartered has a sustainable asset book of 9.2 billion as of 2021. That is a growth rate of about 140% from the previous year. And we are on target to achieve similar or even better levels this year. We have come out and said that we will mobilize 300 billion in green and transition financing by 2030. And shipping stands to benefit from that because it has been identified as a transition industry internally.
Thank you for that. I think prior to this, during lunchtime, we had a quick discussion about the transition element with investments into and the needed investments into the emerging markets. I mean, that's it's not an easy answer, right? I mean, there's a lot of different layers to trying to solve or understand even the issues that may be confronted by investors and banks in doing perhaps the responsible thing in the context of sort of the global scale, but also recognizing that there's a bit of history there, and there's a needed recognition of sort of the requirements and sort of the perspectives that various participants in the different regions present when you're confronted with this transition endeavor. That's why it's never going to be an easy question or an easy issue to resolve. Maybe we can dive into that a little bit more during this session. Quincy?
Yeah, thank you. Maybe it's a very good point, G, you made that it's an interesting mix of banks. So I'm from National Australia Bank, so we are not a government-owned bank, so we're a listed bank headquartered out of Australia. And to date, we are probably 7 or 8 years in our shipping journey in terms of supporting the sector with ship finance, with a $2.5 billion shipping portfolio. Similar to what Steph was talking about on Standard Chartered, so NAB has also signed up to a net zero by 2050. And what the bank has, the steps we've done, we've taken to achieving that target is defining basically caps and also what we will and will not do. So say, for example, as part of that commitment, the bank has capped our exposure to the oil and gas sector to $2.4 billion, which is what we have today, and that's capped, and it will be reducing progressively over the following years. And even and further on the, say for example, the coal side. So the bank has completely stopped financing new coal project, and the aim is to reduce our lending book exposure to that sector by 50% by 2030. But shipping is slightly different. I mean, there isn't I like the power sector, for example, where there's a clear path for renewable energy to sort of transition to. The bank still remains very supportive on the shipping sector without any restrictions. But the important point as well is in seeing the sector, what the bank has done is to create sort of specialist role, and the bank has started training over 100 people. One of my colleagues there is one of them, called Sustainability Champion, which is basically people within looking after different industry to be equipped with the tool set to help their client with transitioning. So these are some of the steps that our banks have taken to date on the transition journey.
Thank you for that, Quincy. So let's move on let's do a little bit of a deeper dive. Clearly, Marine Money is not going to invite any bankers that are not committed to decarbonization on this panel. So the commitment is, obviously we have banks, leading banks, who are committed to decarbonization with the focus on the shipping sector, and the banks are going to be leading players in this transition phase. But let's talk about the why. Let's just kind of taking a step back and looking at it at a macro level. Why is it important? Why is it that the banks themselves should not be just simply on the sidelines and doing a credit assessment, but actually leading in the discussions with the transition in decarbonization in our industry? So going back to Philip there, if you can kind of give some and share your thoughts on that.
Sure. First of all of us, the lenders as well, also the owners of the vessel, wants to secure the equity position. We want to get our money back, the loans back, and the equity owner also wants to secure his equity position. Therefore, we have both interests. To fulfill all guidelines, all emission targets, we as a bank also have signed certain goals to reach. But we are talking about 2030, 2050. So all the vessels which we have today in our book, and our book has an average age of currently 11 years, they will be not there in 2040 or 2050. So we are talking about the future. And yes, we have to make sure that there's sufficient energy, there's sufficient alternative fuels, and that is currently, at least in Europe, missing. We have an energy crisis currently in Europe. So we are talking about, can we further finance coal carriers? We require currently coal. We have no sufficient gas, and therefore we need coal as an alternative for the time being. Not for 10 years, but for the next 2 to 3 years. So also, as long as we have not found yet the parameters, and also I think we have to go one step back. A production of a vessel will also consume quite high CO2 emission. So we have to make an all-over approach and to see which we have today in the water, which can be phased out within the next years, but it will be not the 10-year-old vessel or 12-year-old vessel. That would be a shame. We have to find ways to make the life longer for these vessels and improve the vessels, and banks and owners have to support that. From a risk point, nobody from us wants to finance stranded assets. So that is currently in discussions which we always have. When is the stranded asset come into play? Is it in 3 years, 4 years, 5 years? Everybody knows there are IMO regulations, which is kicking in quite soon, and clients have to improve because otherwise they are risking to lose their air pollution certificate and will be not able to trade internationally. We consider that there's sufficient pressure within the industry, and banks also have to do it, but it would be not the right thing just to say, okay, we just can finance new green vessels. That will not work. We have 90,000 vessels on the water, and we are talking about global trade. Global trade is not working without shipping. shipping is the most efficient way to transport goods. And it will be also in future. And to have windmills, solar panels all over the world will require shipping, for sure.
Thank you for that, Philip. I think that's why you call it transition, right? There's a period of time for the foreseeable future where that's going to be at the forefront of what we have to consider. Stephanie, we also talked about the transition element and a bit of the why. If you can give your thoughts on sort of the reasons why banks need to be leading and at the forefront of this transition.
So you asked the question why, right? And it's not just about doing the right thing. It's not just about being responsible to our shareholders, to our stakeholders. I think the topic itself, climate change is a form of credit risk, right? Climate change becomes credit risk when when there's physical transition risk impacts a client's ability to earn revenue in order to repay the debt, or impacts the value of a collateral. So in a way, it is a form of credit risk if you do not have plans in place in order to transition in a proper manner. Jan mentioned stranded assets. This is certainly a risk that we will consider, we'll take into consideration. And also there's a question whether has the client made sufficient plans to strengthen its financials in order to meet ongoing costs of new regulatory impacts. These are the things that we will take into consideration in our risk framework, very much so moving forward as required by regulators.
So rather than an either-or proposition, the part of the credit analysis
includes it, very much so.
Yeah. Quincy, your thoughts?
Yeah, first I just want to start off with the term stranded asset risk. If I'm thinking back, 3 or 4 years ago, when we talk about risk internally, it was always about technology obsolescence. Is the propulsion system going to be relevant in a few years' time? But it's only the last 2 or 3 years where stranded asset risk becomes the topic of every discussion I have with my risk colleagues. So it is something that has become front and center of what we think about now from a credit risk point of view. I thought I would just start with that. But going back to your sort of the high level of the question, why should banks feel they have a responsibility? I think I'm grabbing words from what different presenters have said over the last day or two. In a way, banking, it is a utility. We provide a critical service to basically to enable the economy to function. And with that sort of responsibility, that power, the responsibility that comes with it is we're in a position to influence people as a primary provider of capital. So I think it is with that power capability that responsibility comes hand in hand. Sound like I'm talking about Spider-Man now, but yeah, but it is that's part of the reason, from a responsibility point of view, why banks just have to look at it and can't ignore it.
Indeed, I think that's part of the calculation, right? So, in the last sort of few minutes that we have on this discussion, let's talk about the challenges. I mean, this topic and the parameters that we've set within the discussion that we've had so far is not without challenges. So, as a bank, as a financial institution, what are the challenges that you see today, that you foresee, that needs to be addressed, and what changes do you want to see in this decarbonization journey that we're on in the immediate future?
We feel quite confident with second-hand vessels because then I don't have to decide what is in 12 years. So our focus is short-term, 4 to 5 years. It is something where we can do our risk analysis, review the values, the collateral values, and see what might happen. If a client goes today to the yard, he will get the vessel delivered in 25, 26, asking for financing 10, 12 years. That's a long, long period. Long, long period. And as we heard before, nobody knows, is LNG maybe in 5 years, 10 years' time a stranded asset due to the fact that it's not good? We will see. I think we need this transition period, and I would recommend to clients to consider if they want to invest into assets, to have that in mind. What is the lifetime? What is the expected lifetime of his investment? What are the revenue potentials? Once for sure, there will be more regulation kicking in, also for the banks. I guess we have to spend more equity for each shipping project, which will not fulfill certain guidelines. That means it will be more expensive for clients if the vessel is not green. But they will still get financing, but they have to pay more because also the bank has to invest more equity to get deals done. As indicated, my personal view is, and also the bank view is, we need further 5 to 10 years until we have all alternatives in place and also sufficient fuel in place. Methanol, ammonia, hydrogen, whatever is the solution. But nowadays, it's like nobody knows will be there sufficient methanol in place in 2 years when everybody has taken delivery of the first methanol vessels. And this is a potential risk where I think everybody has to be careful if he goes today to shipyard to consider what kind of engine type he would select. And therefore also risk-wise, it's easier to review, as indicated, short-term 3 to 5 years than to say, okay, my view is for the next 12 years. That's quite difficult currently.
Stephanie, your thoughts?
I think there are big gaps and there's a lot of challenges and there are no answers yet. I mean, we've heard over the past 2 days, no one really has the answer to everything. But we need to start preparing ourselves towards it. And from a bank's perspective, what that means is we need to make investments in having the right ESG specialists, having the right knowledge to retool our people, to equip our people with the knowledge, investments in infrastructure so that we have the information readily available on what is our carbon footprint. Also collaboration, right? That's why we've joined NZBA. These are platforms, Poseidon Principles. We are now a member of the steering committee. Collaboration to ensure there's information flow, as well as accountability and targets being set.
I just want to start. I do like financing older vessels as well. Ideally, we get repaid before 2030, ideally. But unfortunately, the nature of the game is we are a provider of long-term capital. I mean, yeah. So and it is very difficult to not. I think when an owner is doing a new build and they're installing the LNG dual fuel latest technology, in my mind, at the same time, I think they are doing what they believe to be the right thing to do as part of the transition. So to look away from that and turn away those opportunities, I think that sort of in a way somehow sort of cuts against the transition story. But at the same time, I do agree that personally, yeah, it's much easier to look at a deal where we get repaid by 2030 because, but do all that, that's the tricky part. I think the tricky part is because we're in it for the long term, for the long haul, and going through these periods and seeing how the industry will adapt and evolve and without any certainty, the technology is not even there right now to invest as a debt capital provider to that, yeah, that is challenging. But yeah, to your point, yeah, I totally agree with you.
Well, certainly there's a tension there, right, between the short-term perspective and the long-term goals in the sector. Any questions from the audience?
Any questions? Seem to be on a roll. So I just have a question. I mean, you talk about long-term goals and short-term goals. So this question for Stephanie and Quincy, because Jan's investment thesis kind of just makes sense to me. Also from maybe where I'm coming from as a company. But you know, you also have sort of ROI, and how do you kind of return that in this thinking? Because when you start to go into these alternative investments, maybe it's not so clear, like you're doing the right thing and you're doing it from the long-term perspective, but how do you sort of reconcile that with ROI when it may not be so clear on you know, which vessels to go into, which fuels to go into, et cetera, and I think especially when you're dealing in developing countries.
I'll take it first. I think if you look at how we do our business, right, we are very much client-focused. So I am with the client. Maybe one of the assets they're looking at is an older vessel, and we'll finance it. And then we'll look at a newer LNG dual-fuel vessel, and we'll finance it. So it's a sort of a blend, right? We're looking at a blend. Ultimately, we are there for the client. If we would actually very much prefer if you diversify your risk. I think that's something that banks love, diversification. And we will finance a variety across your asset type.
It was a textbook response. Yep, we are also a very client-focused bank, and
That.
but it is always about supporting the client. But when you support the client, you do have to look at risk because that's the business we're in as when we support clients. Now, to your point about, I guess the question is, how do you factor in that sort of possible stranded asset risks into the pricing of the return? Is that? Yeah. It's an art. It's an art form. I think it's an art form, but no, it's sorry, like everything that we do in credit analysis, it is art more than science, but there is a process of discipline in the art. I mean, for us anyway, I think every deal we do now, doing the ESG analysis and forcing us as a banker to think by going through that sort of checklist, from that's part of the art form when we go through to finally make a decision on whether we will invest in that project. But whether you scientifically add that into factoring, whether the return should be reduced 1%, 2%, or 3%, wish I had that. No.
Well, I think we used up a little bit more time than allotted, but thank you for the panel here for sharing your thoughts briefly this afternoon, and hopefully it was informative for the audience here. Thanks very much.